Everyone seems to think that war is Bitcoin's kryptonite. The second headlines flash red with global conflict, they assume Bitcoin's price will be the first and most predictable casualty. The logic is simple, right? War creates uncertainty, and uncertainty makes people run for safety. Investors start dumping their riskiest assets, assuming the most volatile will be the first on the chopping block. Bitcoin always looks like it's first on the list, but what if I told you that this knee-jerk reaction is just plain wrong? What if the data, when you actually bother to look at it, tells a completely different story? Today, we're going to tear that mainstream narrative apart and look at what's really happening. We're going to look at how Bitcoin actually behaves during major geopolitical crises. You're about to see a surprising and consistent pattern of resilience that flies in the face of the crash story. The story isn't about an inevitable crash, it's about a complex asset finding its place on the world stage. As always, this is just my perspective and not financial advice, so make sure to do your own research. If you found this breakdown helpful, make sure to like and subscribe. The recent conflicts involving Iran are the perfect case study for this evolving digital resilience. So, let's start with what everyone thinks they know. The market playbook is ancient. When things get tense on the world stage, it's called a risk-off event. Fear takes over. Investors sell anything that feels speculative and pile into traditional safe havens. That means US dollars, government bonds, and of course, physical gold. It's the old model. In this model, Bitcoin gets thrown in the same bucket as high-risk, volatile tech stocks. And for a lot of its history, that was fair. During panic, it moved in lockstep with the Nasdaq. When big firms need to slash risk, they sell their most volatile stuff first to get cash. Since the crypto market runs 24/7, it's often the very first place this panic shows up. Prices can tank over a weekend while the traditional stock markets are still completely dark. The go-to example is the Russia-Ukraine war. When the invasion started, Bitcoin did exactly what was expected. It fell off a cliff the moment the invasion started, confirming the risk theory. It fell off a cliff, dropping nearly 12% in just a few hours, confirming everyone's worst fears. This became the default mental model for how Bitcoin would act in any future global conflict. The logic makes sense. War messes up supply chains, spikes energy prices, and fuels inflation. All these factors are poison for risky investments. Even Jamie Dimon warned of the global fallout. If you think Bitcoin is just a speculative tech bet, of course you'd expect it to get hammered. But that initial crash isn't the whole picture. The complicated, fascinating reality is just beginning. When you zoom out beyond the first 48 hours, a clear, repeatable, three-stage pattern shows up. First, there's the initial shock, then stabilization, and finally, a powerful narrative recovery. Go back to Russia-Ukraine. After that nosedive, the risk asset story was quickly replaced. We saw refugees using crypto to carry their savings across borders when the banks were failing them. Russians facing a collapsing currency and government controls also turned to crypto as a way out. By March 1st, Bitcoin had rocketed back to $44,000. It didn't just recover, it rallied. It rallied because the conflict showcased its biggest sell. It's decentralized and borderless. It's a censorship-resistant asset that no single government or central bank can shut down. We saw a similar pattern during the Israel-Hamas conflict. Bitcoin took a dip but found its footing. The market was so focused on spot Bitcoin ETFs that the conflict became mere background noise. Now fast forward to the Iran conflicts. When drone strikes launched in April 2024, the market reacted instantly. Bitcoin's price dropped by 8% over the weekend. The old risk-off script seemed to be playing out. But again, the panic was brief. The market stabilized and started to climb back within 48 hours. It absorbed the geopolitical shock and moved on. Bitcoin is no longer being abandoned in a crisis. The price action showed a new level of maturity. It's being used for quick cash, not abandoned entirely. The data tells a consistent story. Conflicts cause sharp but very short price drops before recovery. The idea that war triggers a long-term bear market is a myth. Regional conflicts are just stress tests. So why does this keep happening? Why does Bitcoin keep refusing to crumble under pressure? The answer is that Bitcoin is having a fascinating identity crisis. It's caught between two stories. It's both a risky tech stock and a form of digital gold. Let me break down how that works. In the first 48 hours, Bitcoin trades like tech. Institutional firms have to cut risk instantly. They sell what's easy to cover losses. Since crypto markets never sleep, it's always the first domino. That's the shock phase, driven by a desperate need for cash, not by Bitcoin's actual purpose. But once that forced selling is done, the second story takes over. Bitcoin as a systemic safe haven. It becomes a hedge against the entire system breaking down. No government controls it. In a world where conflicts lead to frozen assets and weaponized finance, that's revolutionary. We saw it in Ukraine. The government raised $100 million in crypto, skipping the clunky banking system. When trust in government pipes fails, a neutral, global alternative starts to look incredibly good. Second is its absolute scarcity. There will only ever be 21 million Bitcoin. It's written in the code. Regular currencies are printed into oblivion to fund wars, leading to inflation and loss of value. A fixed supply makes Bitcoin attractive as a store of wealth, a hedge against government reactions. Third, it's a bearer asset. You can hold yourself and move anywhere with an internet connection. For those in war zones, this is a lifeline. You can flee with your savings memorized in your head. The spot ETFs add another layer, bringing in long-term investors who aren't just trading headlines. Pension funds are building strategic positions in what they see as a brand new global asset. So you get a tug of war. Short-term traders sell the dip, while long-term holders buy it up. They recognize the unique value of a self-sovereign asset. This is why Bitcoin bends, but doesn't break. Let's put this to the test. Let's apply this pattern to a hypothetical future scenario involving Iran. Imagine military strikes, Operation Epic Fury, kick off on a Friday night after markets close. Phase 1, the initial shock. News breaks. Crypto is the only market open to trade. Panic triggers a lightning-fast sell-off. Within hours, we see a sharp 10% drop. Headlines scream, Bitcoin crashes on war fears. To the world, the crash narrative looks correct. Phase 2, stabilization. As the weekend goes on, the initial panic starts to fade. Smart investors see the critical $60,000 floor. They start thinking about long-term inflation side effects. On-chain data would show whale wallets buying from panicked sellers. The digital gold story returns. The price stops falling and starts trading sideways as the market finds its footing and digests news. By Monday, the worst is over. The market starts pricing in long-term consequences, like inflation. Conflict in the Strait of Hormuz fuels oil and inflation fears, making Bitcoin's scarcity look even better. Bitcoin pushes higher, outperforming stocks as a strategic hedge against the instability it just absorbed. What happens next? As tensions bubble, think in probabilities. History gives us a few likely paths. The base case, short-term dip, followed by a strong rebound as core strengths take over the narrative. The black swan, macro spiral, global energy crisis, short-term pain, but long-term bullish for scarcity. It could trigger a flight from fiat currencies on an unimaginable scale as Bitcoin becomes the escape hatch. The resolution rally, surprise peace. Risk-on rally, Bitcoin explodes on the promise of cheap money. So what should you watch? Don't just watch the price. Watch oil, watch the dollar, watch the whales. Geopolitical events are tests forcing the world to see Bitcoin in a new, more strategic light. The death sentence story is false. It's a dual identity asset perfectly built for our complicated world. The initial drop is noise. It's the selling of short-term players being absorbed by steady, long-term hands. Bitcoin purpose becomes more relevant when the world falls apart. Watch it emerge stronger from every test. What do you think? Ultimate hedge or speculative gamble? Drop your thoughts in the comments below. For more data-driven deep dives, subscribe and hit the bell. Thanks for watching. Stay resilient.